Hello, finance friends. In this lecture, lecture 8 in our series, we're going to be turning our attention to the topics of risk management and specifically to insurance, on what insurance is and on the role that insurance plays as a part of your overall broad personal financial thinking. So what we're going to do is start off kind of on a really top level, get some basic ideas, and then slowly drill down. And at the end, we'll be analyzing different types of insurance that you're going to want to consider having as you think about, again, your overall big financial plan and sort of the financial discipline that you're going to carry through your life. So let's start. I've taught in several previous lectures my idea of the 4 buckets. In other words, I've taught that within personal finance, you're trying to perform activities in 4, buckets or across 4 functional areas. And you remember that those are, number 1, you have to earn money. That's career, basically. Number 2, you have to use your money prudently, use it wisely, use it thoughtfully on a day-to-day basis. And this covers all the boring stuff from previous lectures, those things that they're not glamorous, they're not sexy, but they just have to get done. So we're talking about handling your cash management well and having the right accounts set up and having your infrastructure, your architecture linked, dealing with credit, your credit score, credit cards and loans effectively, handling your tax planning well, knowing how to get shelter and how to make big purchases in an appropriate way. All of those little details that don't seem really important, but collectively really make or break you financially. The third bucket was to grow your money. And that was the lectures that we had on investing principles, and then the lecture on stocks and bonds and mutual funds. And then the fourth bucket, and the one that we turn to today, is you have to protect your money. So when it comes to your financial situation, you need to earn money, use it well on a consistent basis, grow it with investing, and then the last of the 4 functional areas, protect it. And that's what this lecture is all about. It's about risk management, it's about insurance, it's about protective functions. So let's think about the big picture. From the very, very big lens of insurance in the realm of personal finance and economic theory, insurance ultimately protects you from risk. Now, this then leads to another question. So what do we mean by risk? And risk has many meanings depending on the context. But in the context of insurance and personal financial thinking, you can consider risk to be your potential exposure to bad things. Risk can be seen, to put it in simplistic terms, as your potential exposure to unexpected, unforeseen bad things. And that's important because if those bad, unexpected things happen, you face exposure in 2 distinct areas. So insurance protects you from risk, and your risk is exposure in bad situations to one of 2 pretty tough outcomes. Number 1, financial losses, and number 2, legal liabilities. You're going to want to keep this in mind over the course of this lecture video and any further discussion that you have on it. When I'm teaching this in class, I often refer to it as the 2 L's. The 2 L's when it comes to insurance and risk management. You have loss and you have liability. You're going to want to keep those in mind because the insurance tools that you purchase and that you use in order to fulfill their protective function, they have to protect you from either loss and or liability. Okay. Financial losses. This is basically the loss that you incur when something bad happens and your property is destroyed or damaged. It can be the loss of use for an item, the loss of value. Imagine you have a car. Somebody hits you. So now your car is banged up. Well, not only can you no longer use it, but that car before the accident had value as an asset. And that asset value would have been recorded on your balance sheet, for example. Well, after the accident, if somebody hits you, well, now that car is worth less. So you have a loss of value. Your asset base falls. Your wealth level falls. Okay. It also works if you hit somebody else, hypothetically. Think about if you have a dwelling, maybe an apartment, maybe a home, and there's, for example, fire. Well, not only are you not going to be able to use your house or apartment anymore, but what was once assets, your possessions, and if you own the home, your home, what were once assets, that's going to have its value destroyed. And that's going to affect your wealth. So we want to avoid that. The second L is legal liability. And legal liability is your legal responsibility for any financial loss that you cause to other people. So if you, for example, hit somebody in a car accident and you're at fault, you're causing loss to them. Legal liability is your legal responsibility for the financial losses that you cause other people. Okay, so those are our two big L's, losses and liability. And we're going to keep those in mind as we analyze later on different types of insurance. So risk management is a very important idea. And it ultimately, it's fairly simple. People want to complicate it, but it's not that complicated. You can think of risk management as a three-step process. And in this three-step process, ultimately, you are going to have to make decisions and make plans. So risk management ultimately comes down to looking around you, going through these three steps that we'll describe, and then from there, making decisions and plans about how you're going to choose to handle risk. Okay, let's talk about the steps. Step number one, this is just having your eyes open. The first step in the risk management process is looking around at your life, where you live, where you drive, the lifestyle that you live, the way that you live your life, and simply having really what we call soft eyes to kind of look really broadly and open-mindedly and simply recognize and identify the risks that you face. Do you drive to work, for example? Do you smoke or drink excessive alcohol or have other risk factors in your personal life? Do you own a property? And if so, are you renting it to somebody? All of these different things could potentially expose you to our two L's. So the first step is simply just to open your eyes and to look, actively look for your potential exposures. The second step, once you've identified those potential exposures, once you've identified potential losses and liabilities, you're going to want to try to estimate what those are in terms of dollars. If you own a car and if it got banged up or totaled, how much would that cost you to replace? We're putting a dollar value on it. And you do the same thing with your liabilities. So in step one, you identify your potential risks, your potential exposures. In step two, you try to put numbers on those exposures and risks. And then once you've done that, now you have to do some analysis and make a decision. Because when it really comes down to it, when you're dealing with risk, we all have 4 potential methods to deal with risk. Okay, so imagine any risk that you might face. You drive and there's potential risk for car crashes or whatever risk you might face. There are ultimately, at a very broad level, 4 potential methods to deal with those risks. The first method is just to avoid the risk. So let's use driving a car as an example. So you have a car, you drive. So there's always potential risk that somebody will hit you or that you'll hit somebody, or that maybe you'll hit a structure or a building. So we're going to have our two L's, the potential loss of value from your vehicle if you're hit, or if you hit somebody, and your potential legal liability if you're at fault. So let's use this as an idea, as an example. So how do you now deal with those risks? Well, the first method, you can avoid the risk. Simply not drive anymore. This is a very common way to avoid some risk. You just avoid the behavior that generates the risk. That's risk avoidance. Now, obviously, it's going to be pretty difficult to not be able to drive. So this may not be an option for you, but it is an option. So one potential method, avoid the risk. A second potential method is to reduce the risk or mitigate the risk. This will be called a risk reduction strategy. So in the context of you driving your car, it would mean that you always drive the speed limit. You discipline yourself to not text or talk on the phone when you're driving. You never drink and drive. You always, you drive safely. You watch the road. In other words, you wear a seatbelt. You engage in activities that will reduce the risk. Think about wearing a seatbelt or even having a car that has airbags and a good safety system. It's not going to eliminate your risk, but if you were to get hit or hit somebody, it would definitely reduce the risk. So that's the second potential option. The third option is called risk retention or risk assumption. This is where you simply say, I understand the risk and I'm going to take it on. Okay, so this would mean that you drive, but you don't really take any precautions, and critically, you don't have any insurance. You simply go with the flow, and if someone crashes into you or you crash into somebody, you just accept what comes your way. This, in the context of driving, fairly dangerous and not advised. But then again, think about other areas. You buy a new phone. What if, for example, you buy a phone and you have to make a decision? Should I get phone insurance? Well, maybe you say, no, I don't really think I'm going to drop the phone. I've never dropped a phone before. And even if I were to drop it, I can afford to buy a new one. So you simply say, I'm not going to buy phone insurance. I'm just going to assume that risk or retain that risk. That's our third strategy. Notice, again, we used cars and we used phones. This strategy really depends in large part on the potential loss that you might take on. A phone that cost you a few $100 to $1,000, maybe you retain that risk. But a car that might cost you $25,000, $30,000, not to mention really, really expensive injuries if you're involved in a crash, maybe you don't retain that. So those are our first three. But where we really get into insurance is our fourth option. And this fourth option is effectively risk transfer. So we can avoid the risk, reduce the risk, just take the risk on. But the fourth option is transfer the risk. Okay? Risk transfer. And this is ultimately what insurance is. Because when you buy insurance, what you're doing is you're paying money to an insurance company. So you're exchanging in an exchange, you're exchanging in a negotiation, in a transaction, you're paying money, and in exchange for that, the insurance company is agreeing to accept the risks that come if you crash your car, if someone hits you. So that's our fourth potential method. It's risk transfer, and this ultimately is what insurance is. So it's important to know we're talking about insurance, but it's just as important to know from the big picture that insurance is just one of four ways to handle potential risk exposure. Okay, so that's our risk management. Now, when you take a look at those four methods, hopefully what you can start to see is that risk management, it's not really complicated, but it does require you to think. And ultimately, you have to make some strategic decisions. Which risks should you avoid? Maybe you say, I'm never going to skydive, I'm not going to smoke, and I'm not going to go to Pamplona, Spain and do the running with the bulls. Okay? Which risks do you avoid? Which risks do you reduce? Which risks do you just accept or retain? Which risks do you insure? And, for example, we've already kind of seen this when we contrasted your car with your phone. You might be very comfortable just assuming the risk, retaining the risk on your phone in the event of it dropping or being lost or stolen. You say it's a few $100s, it's $1,000, I can accept that. I'll retain that risk, I'll accept it. But maybe you're not going to do that when it comes to driving a car. Okay. So ultimately, because you have 4 options, risk management is making decisions, making strategic decisions, and then accepting the trade-offs that come with those decisions. And like we said, you're going to want to ask the questions in the context of your personal finances. Which risks should you avoid or reduce or assume, and which should you transfer via insurance? By the way, this does lead to another question. Now that you know what insurance is in the context of risk management, should you insure against all your potential losses? Is every potential risk event something that you should insure? Maybe, maybe not. We just said you may not want to insure your phone, but maybe you do. Or suppose that you book a trip to Europe for a vacation. You're going to get that little pop-up on the screen after you buy the ticket from the airline, and it's going to say something like, do you want to purchase trip insurance or, travel insurance? You'll have to ask the question, what does this insurance bring me? What does it cost me? Given this potential cost and benefit, am I better off buying that product and buying the insurance, or just accepting and retaining the risk? And remember, ultimately, it's about the trade-off. Because every dollar that you spend on an insurance product is a dollar that you no longer have available for other potential uses. Okay? So that's kind of the big picture. Having said that, I would offer to you one general guideline when it comes to your own decisions. And what I would offer to you, and this is a rule of thumb that most insurance professionals also would advocate, how about this? Only buy insurance when 2 things are going on. Number 1, when the frequency of the event is low. Car accidents should be for you a very low probability event. A house fire should be for you a very low probability, low frequency event. So I would say that the first criteria, you buy insurance when the frequency of the event is low. And then the second is when the severity is high. So insurance is best suited to risk exposures that are going to be low probability. There's not a real big chance they're going to happen, but high severity, meaning if it did happen and you didn't have insurance, you could really be hurt financially. Okay? Having said that, this then leads to what I would offer are the key questions that you as a consumer should be answering as you look to insurance. So as you navigate the world of insurance, I would offer to you 4 questions. Number 1, you should ask yourself, what types of insurance do I actually need? There's a whole lot of insurance types out there. You can insure almost anything in any event, but you should ask, what types do I really need? Once again, going back up here to thinking about low frequency, high severity. Number 2, once you decide on what insurance you need, you then have to ask at what coverage level. Because buying the insurance is just one decision. You then have to decide, how much coverage do I have? Do I have high coverage or low coverage? You'll have to answer a technical question on the loss valuation method or the claim settlement method that you select, which we'll discuss in a bit. And then because ultimately insurance is a transaction and you're going to be paying money for this product, you're going to always want to think about getting the best tool for the job, as we said, getting the right insurance product and paying the lowest possible price for it. And that will then lead you to ask, what factors might influence those prices? This is going to be especially the case when it comes to things like auto insurance or maybe life insurance or health insurance. Okay. So there's some top level stuff. In terms of insurance itself, so you decided on all the things, you know, you're going to buy insurance, you know what type you're going to buy, you know what coverage you want. At the end of the day, all insurance is just a contract. Any insurance policy is ultimately a contract. It's a contract that you and the insurance company engage in. And when you engage in that transaction voluntarily, you agree to transfer risk to them in exchange for paying them money. So all insurance is just a contract. And this means that really the components of an insurance policy aren't all that different from any other type of transaction. They may have different names, but the concepts are the same. Okay. So component number one, the policyholder. That's you. This is the person who is buying the insurance. Component number two is the counterparty to that transaction, the insurer. The insurer is the person who's offering the insurance policy. But from a more technical perspective, the insurer is the entity that is going to accept money from you in exchange for a promise to cover your losses if and when they happen. So you can think of the policyholder and the insurer as the two parties to this voluntary exchange. Coverage refers to the amount of money at play. In other words, what is the specific amount of protection, usually measured in terms of dollars, that this insurance policy provides? Premium is the fancy term for the fee or the price of the policy. So the premium is simply the amount that you, as the policy holder, have to pay to the insurer to make this transaction work. Okay, so it's just a really simple market transaction. There are, however, two specific things that are a little bit more nuanced into insurance that I want to hit briefly because you need to know these things. So I'll put them in these colors. Number 5, exclusions. And number 6, riders and endorsements. Exclusions refer to items that are not covered by the policy. This is very important because if you're going to buy a policy, you can't go in naive thinking that, oh, it's going to cover everything. You know, if you buy a homeowner's policy or a renter's policy for an apartment, first of all, not everything is covered. Some things are excluded. It's critical that you understand what those exclusions are because you want to know where your exposures are. So exclusions are items that are not covered by the policy. And then sort of the opposite of exclusions are what we call riders and endorsements. Riders and endorsements are provisions that allow you to add additional items to any policy or to increase coverage for particular items. So let's say that, for example, you're an art collector. You have a house, and in your house, you have hung up on your walls some really expensive art. Your homeowner's policy will cover your house in a standard way. But your homeowner's policy is probably going to exclude your very expensive artwork. And as a result of that, you would want to work with your insurance company to write up a rider or an endorsement that would allow you to add your artwork to your policy. So it's just really these two things here are ultimately all about making sure that your policy is perfectly tailored to your needs. Now, the other thing about insurance that you're going to want to keep in mind There's a lot of jargon involved, and it's not hard, but it's really important that you bear in mind and that you understand what insurance companies mean by certain words. And three of those words that come up a lot are peril, hazard, and negligence. Okay, first, peril. Peril refers to the actual cause of any loss or liability. So we have our two L's, losses and liabilities. Peril refers to the actual event or the actual cause of those losses or liabilities. So the fire, for example, or the car accident, for example, or the robbery or the illness, these are the specific causes that trigger losses or liabilities. That's the peril. Hazards are any factors that increase the probability of a peril. So again, a peril is the actual cause of your loss. The hazard is any factor that increases that. So if a car accident is the peril, driving drunk is the hazard. It's going to increase the likelihood of the accident. If the fire is the potential peril, you own a home, fire is a potential peril. Well, having faulty wiring in your home that you haven't fixed, that might be a hazard because bad wiring increases the probability of a fire. Let's say that you own a home and one of the perils that you might face is a guest or a visitor to your home getting injured on your property. So the injury to a visitor, that's the peril. Owning a dog or having a pool in your yard are two big hazards that would increase the probability of the peril of somebody getting hurt on your property. Okay? So hazards, perils, and then finally negligence. And you can think of negligence as when you fail to take sufficient precautions to prevent accidents from happening. So we can think of perils as the cause of loss and liability, hazards as factors that increase the likelihood of a peril happening, and negligence as occurring when you fail to take specific reasonable precautions to prevent it from happening. Okay, so they all work together, but it's really important that you keep those specific terms tight. Two other terms, which are also parts of most policies, are deductible and coinsurance. Okay, deductibles and coinsurance are two provisions of most insurance policies. What do they mean? Well, a deductible refers to an initial portion of any loss that you have to cover before your insurance kicks in. So let's say that hypothetically, you have a homeowner's policy and your homeowner's policy has $1,000 deductible. Then let's say that there is something, maybe a fire, maybe a robbery, it doesn't really matter. Let's say that something occurs that causes $9,000 of damage. So you have a policy, you have $1,000 deductible, and something bad happens, something unexpected happens that causes a $9,000 damage to your property. Well, the deductible means that you have to pay that $1,000 out of pocket first before your insurance kicks in. So in the example that I just gave you, you have $9,000 of damage. You're on the hook for your deductible. And then once your deductible is paid, your insurance company kicks in the difference, which in this case would be $8,000. A second term is called coinsurance. With coinsurance, this means that you, as the policyholder, and the insurance company, as the entity that takes on the risk, you share as measured by a percentage in the payment for a loss. So let's do another example. Let's say that you have health insurance, and let's say that you have an 80-20 co-insurance split. This means that 80% of the claim is paid by your insurance company and 20% is paid by you. So let's say that you have a 1,000, let's say that you have an accident and you have to go to the hospital, maybe get something fixed up, and that hospital visit cost you $1,000. Well, under a co-insurance scheme, 80% or $800 would be paid by your insurance company, and 20% or $200 is paid by you. So once again, it's a way for you and the insurer to sort of split it. Notice that these two can also be combined. So it's possible to have a policy with both a deductible and a co-insurance payment. In that case, you would pay the deductible first. You as the insured pay the deductible first out of pocket. And then whatever amount is left over is then split by the co-insurance percentages that your policy has. So those are really important. Now you're asking, so why is this important and what does it all mean in terms of, this whole thing of insurance? Well, here's the key. One way that you can reduce your insurance costs is by adjusting your deductible and co-insure numbers. The general rule is the more that you're willing to pay out of pocket, the lower your premium is. So if you ever have the option of adjusting, let's say your deductible, if you accept a higher deductible, you'll be rewarded with a lower insurance cost. And if you accept or you ask for a lower deductible, the insurance company will give you a lower deductible, but you'll have to pay more money on your premium. So you can think of deductibles and co-insurance numbers as one of a small handful of factors that you have in your control to lower your cost of insurance. Okay? Another big part, which we mentioned earlier, now we'll explain it now, is the claim settlement method. So you have insurance, you're involved in an unpredicted, unexpected event, maybe a car crash, for example, or, a fire at your apartment or whatever it is. You file a claim. Your insurance company agrees to the claim and they agree to pay you a claim settlement. The question then is, how does the insurance company determine how much to pay you out? And there's two basic ways that insurance companies we'll say, value losses. And valuing losses is the same as saying settling claims, because whatever amount they value your loss at, that's the amount that they're going to pay you in the claim settlement. Okay, so there's two ways that your losses can be valued. The first way, which is known as the ACV method, is actual cash value. Under the actual cash value method, your items will be, I shouldn't say replaced, let me take that back. Your claim will be paid out, your losses will be valued, your claim will be settled as a function of what it would cost to replace the item minus any depreciation that has already been applied to the item. So let's say that hypothetically, you buy an item that has I'll make this up to make the math easy, a 10-year useful life. And then suppose that something happens after you've owned the thing. So it's got a 10-year useful life. You've owned it for 5 years, then it's destroyed. Since you have used up half of the useful life of the item, that means that half of that item's value has been depreciated. That depreciation will be subtracted from any potential settlement that you're paid out. Okay. On the other hand, you have what's called replacement cost method. And under replacement cost method, depreciation is not factored in. It doesn't matter. You bought an item, it's got a 10-year lifespan. You bought it 5 years ago and now it's ruined, it's destroyed. Under replacement cost method, your insurance company will give you the full amount that is required right here, right now, to replace that item that was destroyed. And they don't factor depreciation in at all. Okay. In practical terms, what this means is that replacement cost method will always pay you a higher settlement claim than ACV. You'll always get a bigger, larger settlement under replacement cost method. But the flip side is replacement cost method will cost you more money. Since the potential exposure to the insurance company is higher, you have to pay a higher premium. Okay, you'll have to make your decisions based on your needs and on your own risk analysis, which we learned about earlier. But just know I bring this up because ultimately, number one, you need to know your coverage. And number two, you want to make sure you understand how it's going to cost you. And your choice of claim settlement method is going to be a big determinant in that. Okay, so that's pretty much it for the top level picture. In a moment, we're going to go into all the specific types of insurances that you might need in a little bit of detail. But before we do that, I will leave you with one big picture, top level thing, and that would be 8 broad principles of insurance planning. In other words, whatever you're doing when you're looking for insurance, what are some top level principles that you should keep in mind? And I would offer you 8. Number 1, have knowledge. Know what phase you are in your life cycle. Are you just out of college living in an apartment? Are you now just newly married and you bought a house? Do you now have children who rely on you for their needs? Okay, whatever phase of your life you're in, you're going to have, depending on that phase, different risk exposures. So the first principle, know where you are, be aware, know your life cycle phase, and understand your risk exposure. Number 2, this should be fairly easy if you've done your cash flow statements, know your budget. Know how much insurance you can afford. Once you understand that and you go shopping around, number 3, understand the key types of insurance that are available to you. What kinds of insurance can you buy? And then, given your risk exposure, once again, we go back to the big theme, know the potential types of insurance, and then know how to pick, as we always say, the right tool for the job. Once you pick that right tool, understand it in depth, understand the details and the coverage, understand the premiums, understand the benefits of all the insurance products that you buy. You do not want to be naive or uninformed. And this can be difficult because insurance is filled with jargon. There's a lot of little fine print. It can be overwhelming. But you have to go through the steps of educating yourself so that you buy the right tool for the job and that you understand it. Now, this can be hard. You can do it. I'm sure you can manage it. But if you say, Eric, that's just too much for me, that's okay too, because there's help available. You can find an insurance broker. And a broker is a trained professional, usually with lots of experience in insurance markets and oftentimes having gotten certificates or licenses that prove that they've gone through some training and passed some exams that demonstrate knowledge. Okay. If you choose to work with the broker or not, our fifth principle stays the same. Only deal with high quality. Only buy insurance from high quality companies. You don't want to cheap out on this and buy insurance based on some sign you saw on a billboard on the freeway, because you need to make sure that this insurance company is solid, so that if you ever have to file a claim, they'll be in business still and they'll have the ability to make the claim pay out. So only work with high quality institutions. And if you decide to get a broker, only work with high quality, trustworthy, good people. As we said before, think about the probability and severity thing, and only insure against high severity losses. Okay, you can spend a lot of money insuring on lots of little small item, low severity things. You probably don't want to do that. Remember, the goal of insurance is not to make you whole for every potential bad thing that can happen, but rather to protect your wealth if a big thing happens. Okay, so you want to really focus on insuring against high severity losses. You're going to want to keep your insurance tools and your investment tools separate, and that'll make more sense in a little bit. And then finally, the eighth principle: nothing is static in this world. Nothing is static in your life. So just like you're going to do with your portfolio and with all the other aspects of your life, you're going to want to set aside time every year. I suggest that you have a little financial calendar where you just mark out all the things that you're going to do throughout the year. One of those things should be, at least once a year, review your insurance needs, review your policies. Every year, it doesn't take long. You just take a quick look. Okay, in the last year, has my life changed? Do I have any more potential exposures? Do I have any more new needs? You just review yourself once a year, just to make sure that the tools that you have are still the right tools for the job. Do it every year. And also do it anytime you have a major life event. When you get married, have children, if you and your partner divorce, or if your spouse dies, when your kids go off to college, there's anything that triggers any major life event is going to probably trigger a change in your exposure. Use that life event as a reminder: I better review my coverage and make sure that I know where I'm at and that I still have the right tools for the job. So those are the big principles. In the remaining part of this lecture, we're just going to take a very fast journey through the different types of insurance that you might have. Okay, I'm going to outline a couple. Here's the best way to think about it. We're going to talk about insurance, and there's a few different tools that I'll share with you, but at a kind of a top level, you can think you're either going to insure your stuff or you're going to insure yourself. We're still talking about the two big L's, losses and liabilities, but we're going to now break those up into tools that are either insuring your stuff or insuring yourself. So let's start off with the first type of insurance, auto insurance. This is the first type of insuring your stuff, because a car is something that you own. Okay, so insurance number one, auto insurance. And the big thing to understand about auto insurance is, number one, you need it. You need appropriate coverage. And number two, you need it because for most Americans, regardless of age level, statistics show that driving a car is the single largest potential exposure to catastrophic loss. Okay. Most people at some point in their life will drive. Driving is the single largest potential exposure to loss and liability for most Americans. And as a result, you need auto insurance. You need auto insurance because ultimately, what a good policy does is it provides you with protection, once again, against our two L's. financial losses, and legal liabilities. In the context of driving, financial losses, which is basically the loss of use of your car or the loss of your car's value if it's banged up or even totaled, this is going to come from accidents or maybe vandalism, maybe natural events like hail or theft. So that's the loss of use. Liability, this is going to come when you are responsible for an accident that causes injury or damage to somebody else. Okay. This can be very, very expensive. And if you're underinsured or non-insured, a car accident can really ruin you in a matter of seconds, ruin you financially. So you have to have good coverage. Notice here I say you have to have appropriate coverage. Every state actually, including California, they have a legal minimum requirement. So if you were to look up California minimum car insurance, you would see what California's minimum thresholds are. But I'm going to tell you right now, those minimums are a joke. You need appropriate coverage, not minimum coverage. Remember, insurance is designed to protect your assets in case bad things happen. So you need to have sufficient coverage based on your asset level. Notice that this is going to generally be far more than your state's minimum requirement. And notice also, once again, life cycle phase, that as you get a little bit older, more established in your career, you start acquiring more assets. As your assets grow in value, your potential exposures and losses will grow in value. And you want to make sure that your insurance keeps up with that. Okay. There are 4 general kind of broad categories of auto insurance. So let's go through them quickly. The first one is liability insurance. So liability insurance covers you when you cause an accident that causes other people to have losses. So liability, one of our 2 big L's, this is insurance that covers you if you make an error driving and you are held by the courts to be legally responsible for injuries or losses of somebody else. Notice that the losses to the other people can be one of 2 types. Either losses tied to bodily injury that you caused them, or losses tied when you damage their property. So you cause an accident and you hit another car, and the driver of that car sustains a broken arm. Well, now you're on the hook for the bodily injury that the driver sustained, as well as the property damage because you broke that driver's car. Okay, so that's liability insurance. The second type is physical damage insurance. Now, this covers damage to your car. So the liability up here covered losses and liabilities to other people or their stuff when you're at fault. Physical damage covers damage to your vehicle. This damage can be of 2 types. And again, don't get overly worried about the jargon. Just kind of know it and practice it. You'll get it. Physical damage, damage that can occur to your car, is typically classified into one of 2 subtypes, either collision or comprehensive. Oftentimes, in fact, if you have car insurance, you'll often hear physical damage insurance sort of jargoned or shorthand to C&C insurance or collision and comprehensive, because those, collision and comprehensive, are the 2 main types. The differences are pretty trivial, but you should know them. Collision is when the damage to your car results from either hitting another car, hitting an object, or a rollover. So collision covers damage that results from another car, an object, or a rollover. Comprehensive covers everything else. So comprehensive would cover vandalism. It would cover, you live in a state like Texas and you get these baseball-sized hailstorms and it just ruins your car with this hailstorm. That's not caused by another car or by an accident. It's caused by the hail. So collision covers other cars, objects, or if your car rolls. Comprehensive covers everything else. The third type is uninsured or underinsured motorist coverage. Now, this is interesting. I want you to assume that you're driving and you're doing everything right, and another car hits you, either hurting your car and or hurting you physically, body-wise. Obviously, if that other driver is at fault, that other driver and their insurance company have an obligation to make you whole. So far, so good. But what if that other driver is uninsured? Or what if they have a really crappy insurance policy that doesn't even come close to covering the full extent of the damage that they caused you? That is where uninsured and underinsured coverage kicks in. This is it's very inexpensive and you probably need to get it. This is insurance that covers your losses when some idiot or jamoke who doesn't have enough insurance is at fault. Because if they don't have enough insurance, you're on the hook out of pocket for whatever their insurance doesn't cover. Well, obviously, if the point of insurance is to protect your wealth when bad things happen, and if this jabroni who hit you doesn't have insurance and you have to pay out of pocket, we have violated that goal of protecting your wealth. But this is an easy way to protect that. And then the final one is medical payments insurance. And this covers injuries or hospital stays for people in your car, including both you and passengers, regardless of who was at fault. So those are the four main types of coverage: liability, physical damage, also called collision and comprehensive, uninsured motorist, and medical payments. Now, this sounds like a lot, but fortunately, most auto policies are very standardized boilerplate tools, so they're very consistent, which makes shopping very easy, okay? Part of what these plans do, and they can be called FAPs for family auto plan or BAPs for basic auto plan. But one common thing is that these policies, they all have limits to the coverage. Like, what's the upper level that they'll cover? Those limits are expressed in a common shorthand where you have three numbers in a row, okay? So here's an example. Suppose that you have an insurance plan that gives you 20, 40, 15 coverage. Or suppose that you go shopping for a plan and you buy a plan that has 100, 300, 100 coverage. Notice that in both of these, there's three numbers and they're separated. First things first, those three numbers are in units of 1,000. So technically, this one would be 20,000, 40,000, 15,000. And this one would be 100,000, 300,000, 100,000. Okay, so those numbers are shorthand for in thousands. But then what do they mean? Well, each of those three numbers has a different meaning. The first number, in this case, 20,000 or 100,000, the first number is the upper limit that your policy will cover for bodily injury for one person injured in the accident. So let's say that you have this plan here, 20, 40, 15, and you cause an accident and you cause $30,000 of bodily injury to the person that you hit. Okay, not good. Well, if your plan is a 20, 40, 15, then the limit for any one person is 20,000. So that's the upper limit. Now you're thinking, okay, well, you just said that I caused $30,000 of damage. My plan only covers 20. So then what happens? Well, what happens is you're going to be held accountable for the difference, and you'll have to pay that out of pocket, which is going to be a big hit on your finances. So you have to have appropriate coverage. So the first number, bodily injury for any one individual hurt in the accident. The second number is also for bodily injury, but this is for all the people collectively. So in this case, it's 40,000. So let's say that you hit another car and there's 3 people in the car that you injure. So you hit a car, you injure 3 people in the car. The first person has $10,000 of injuries. The second person has $30,000 of injuries. The third person has $18,000 of injuries. Well, under our first number of 20, this person will be covered for 10, the full amount, because it's less than 20. This person's only covered for 20. And this person's covered for 18. That's what the first number tells us. But now look at this. 10, 20, and 18, this makes $48,000 in total damage. The second number here, the 40, this is the limit, the total, the cumulative limit for the entire accident. So in this case, if you caused $48,000 of total damage, your insurance will cover a max of 40 because that's the second number. That leaves you exposed for the other 8, which you'll have to pay out of pocket. Okay. And then the third number, sorry, go back to our pens. The third number is property damage. So the first 2 are body. The third one is property. And that's the property damages resulting from the loss. So in this case, your limit is 15. Well, if you do $20,000 of damage to that person's car, your policy will only cover 15. You're on the hook for 5. It's really important if you think about it. I mean, look at the world around us. Inflation has been skyrocketing. It costs a lot of money now to repair cars. It costs a lot of money to repair buildings. All damage is increasingly expensive to cover. So if you're really low in that number there, you might be stuck with a bill that you have to pay out of pocket. Okay. Anyway, so that's what these numbers mean. It's always going to be in this 3-digit shorthand, where again, the first number is bodily injury for one person. The second is bodily injury for all people combined. And the third is property. Okay. There we go. Final thing, because we're going to need to look at your premiums now. What are the factors that will influence how much your car insurance will cost you? And there's really 3. The first one is you. Just the driver is a big predictor of insurance costs. And some of these are within your control and some aren't. For example, your age, your gender, and your marital status will contribute to your insurance premiums. Men will typically pay more for auto insurance than women. Single people will typically pay a little bit more than married people. And younger drivers, especially teenagers, will almost always pay more than someone my age. Okay, so that's that. Also, your education. Now, there's a couple of other things that can influence it, which you wouldn't think. And once again, we go back to a previous lecture on the importance of having a good credit history and a good FICO. Your FICO might be a criteria. Your credit score might be a criteria in your premium. And then also your driving record. I mean, if you have a clean driving record, you're going to pay a lower rate. If you're bumping into people every 18 months, insurance will see you as a potential risk factor and they're going to charge you more because, as we learned, if they're taking on more risk, they have to have more return. Okay, so that's the first factor, you. The second factor is your car. Typically, the model, style, and age of your car are going to be factors. Another thing that might be a factor are also safety features. Typically, cars that have better safety features might have lower premiums because the argument is that they're going to have less chance of you getting hurt in them. So the safety features can help you. And then the third thing, which again is really not in your control, is your what they call the driving region. In other words, the zip code where you live. This isn't always necessarily a fair thing. It's the way it goes. If you live in a zip code that just statistically has more accidents, more theft, more stuff going on, you're going to pay a higher premium. And if you live in what would be considered a safer zip code, you'll probably pay a lower premium. Okay. You may not like this, but that's just the way it goes. So there's going to be three factors that are going to primarily influence your premiums. You as the driver, your car, and your geography. Given all this, what are ways that you can lower your premium? Well, there's a few steps you can take. Number one, increase your deductible. Higher deductible, lower premium. Also, shop around. It's always worthwhile when you review your insurance need to shop around online or use a broker or even call the insurance companies yourself just to get quotes and see if they can beat each other. You may not find much of a difference, but it's worth shopping around. Bundling, where you get all your different insurance types from one company. So your car insurance and your renter's insurance from one company. Bundling can also save you money. At a personal level, have a clean driving record, okay? Drive safely. Don't be stupid behind the wheel. And fight for and maintain a strong FICO score. That will help you. So might taking some driving courses. Taking courses in how to be a defensive driver, how to be a better driver, will illustrate to the insurance company that you take your driving more seriously. That signal might result in a lower premium. You can also do some risk mitigation, maybe putting on car alarms or anti-theft systems, things like that. And then finally, at least while you're in college, maintaining a high GPA will also help you. Okay, so there are some factors that can affect your premiums, either up or down based on your choices. And that, my friends, is auto insurance. Let's now turn to the second type of insurance for your stuff. And this is homeowners or renters insurance. Now, these are used interchangeably because they behave in much the same way. Homeowners is going to be purchased by you when you buy a home or a property, and renters when you're renting in somebody else's property, renting an apartment, renting a condo, renting a house. So we're going to separate them as renters and homeowners based on your status if you're a renter or a buyer, but ultimately they behave the same. And what these policies do is they combine the coverage that you need into one single package. They combine both the loss and the liability facets of home ownership or rental into one package. Okay, this insurance is very inexpensive, and therefore it should be considered to you essential. It's going to protect you. That's the key. All insurance is protective. It's going to protect you if and when there is damage to your property, there is theft from your property, there is destruction of your items on your property, or increasingly, if you own property and something happens to somebody who's visiting and they file a claim against you. Okay, so that's what these are. Broadly speaking, these policies will cover, number one, damage to the dwelling itself. We're going to assume right now, by the way, a homeowner's policy. So you own a home. This homeowner's policy will cover damage to the house building itself. It will also cover damage to any other structures on the property. It will cover, so these are structural things like the actual home itself. These policies will also cover damage to any of your personal property or the contents of the dwelling, all your furniture or anything inside of it. So if your house burns down, not only will these policies cover the house itself up here, but they'll cover down here the loss that you suffered to your property when it all burned up. Okay. Suppose that your house burns down and now you have to go and you have to rent a place for a few months till your house is rebuilt. These policies will also cover expenses tied to loss of use of the dwelling. And then finally, if anybody gets hurt on your property, these will cover liability losses that you face. So again, we know our two big L's, losses and liabilities. Loss of use, loss of value, and liability if you're legally held accountable. These policies will cover all of those. They're not really expensive, and that makes them essential. Okay. So let's now get into some basic ideas, and then we'll kind of get into a couple of nitty-gritty slides. Knowing that risk is going to either come from loss or liability, how do you go about thinking or conceiving of these policies? Well, there's a few steps you can take. The first step is going to be just open your eyes and look around your property, look around your dwelling, observe with soft eyes and an open mind, and then think critically, think open-mindedly about your risks. You know, what kind of neighborhood do you live in? Is there a lot of potential theft? Do you have expensive things inside? Do you have good quality locks or an alarm system? Do you have a dog that might bite somebody when they come on your property? Do you have a pool where somebody might get hurt and slip or maybe drown? Terrible things, all of these. But to really think about insurance correctly, you have to think critically about risks. And that's not always comfortable, but you have to do it. The second thing that you can do is make an inventory. You should get in the habit of creating an inventory of all of the assets that are in your home, of all of your home's contents. And while you're doing the inventory and making a list of all the things in your home, also figuring out what would it cost to replace those things. Notice that this inventory can serve you two purposes. Purpose number one, it'll help you get the right level of insurance. But purpose number two, go back to our balance sheet. Remember our balance sheet that we learned about in a previous video. We learned that you have to track all your assets and that those assets include cash assets and personal assets and financial assets. This inventory would tie into how you value your personal assets. So once again, we see the interrelated nature of good financial thinking. So principle number one, basic idea number one, look around your dwelling, think about your risk critically. Big idea, basic idea number two, get an inventory written. Number three, especially when it comes to your home, do not do ACV. Do not do actual cash value. Spend the extra money to get the guaranteed replacement cost coverage, especially with the home. Homes can be very expensive to replace. Even right now, labor costs are going up. Construction material costs are going up. From one year to the next, the potential cost to repair a home has gone up by a significant percentage. You don't want to be stuck on an actual cash value basis where you might be forced to pay a lot of money out of pocket. Protect your wealth, protect your financial stability, and especially when it comes to a homeowner's policy, get that guaranteed cost. And then once again, have knowledge. You really have to understand what your home policy includes and what it excludes. What are the exclusions? And by looking at your inventory, you're going to be able to say, do I need riders? Do I need endorsements on this property? Okay. This tool is designed to support you and to protect you. So go through the steps to use the tool properly. All right. Now, this all sounds very hard and it can be confusing, but fortunately, to help you out, typically the insurance policies that homeowners and renters buy are standardized, and it's called an HO. So you have here a few. You have HO1, HO2, you get all the rest. You can see when you look at each one. So, let's say look at HO1. This is basic home insurance. So an HO1 policy is a basic home insurance policy. It covers 10 perils. And an HO1 policy will have no coverage for your personal belongings. So that's HO1. In contrast, in HO2, it's still a home policy, but it's broader. By being broader, this means that it covers more perils. This one had 10, this has 16 perils, so you have wider coverage. Also, HO2s cover your personal property and your loss of value. So what you can basically see here is that based on the type of coverage that you want and need, you're going to get a different type of HO plan. For renters, while you're in an apartment, that's going to be an HO4. If you own a condominium, that'll be HO6. You get the idea. Okay, so this is still a lot to think about, but it does take a lot of these things from this slide and sort of simplifies it, because ultimately you're going to get sort of a boilerplate package that'll make your decision and your pricing easier. Now, in case you're curious what most people do, when it comes to homeowners, the most common policy is an HO3. In fact, insurance data suggests that in 2020, which was the last year I can find data, 78% of homeowners had HO3 plans. An HO3 is this. It's what's called the special form policy. And what makes it special is that it offers what's called open perils. Notice that HO1 covered 10 by name and HO2 covered 16 by name. That means that if something bad happens to your house that is not named in those plans, you, my amigo, are out of luck. But an HO3 is broader because it's open perils, meaning that far more things are covered. Okay, so that's an HO3. It covers, as we just said, all potential perils except for ones that are specifically excluded. So this is just going to give you better coverage. This thing will not tell you what is covered. It really says everything's covered except for these things that we list. So you have a much better idea of your exposures and of what you need to do to supplement that. Okay, these package policies will cover your dwelling, other structure on the property, all of your inside personal property, loss of use, and generally 100,000 to $500,000 of personal liability. So they're really good plans. Now, I had said up here that they cover everything except for stuff that is excluded. So you might be asking, well, what's excluded? And typically, you have to shop around and really read into it, but typically, the typical HO3 policies exclude earthquakes, floods, intentional loss, like if you break your stuff on purpose. Don't know why you would, but I don't know, maybe having a bad day. Neglect, nuclear hazard. This escalated quickly. War and government action, damage caused by animals. And notice that these plans do not cover the property of renters or business property. It is strictly personal ownership. So suppose that you have a 5-bedroom house with an HO3 plan. You rent out one room to a renter, and you have one room for a home office. Technically speaking, your renter needs to get their own renter's policy, and you as a business owner need your own business insurance plan. So if your personal residence, your home, is either rented out to others, or if part of it's used for business uses, the business component and the rental component are not covered. So you'll need supplemental policies. HO4, this is designed for renters. Now, most people think of HO4 as renting an apartment, and it is, but this is renters in general. So you can rent a house or a condo or an apartment. Any rental setup is covered by HO4s. You'll notice here that they protect your personal property. They'll cover you against liability, and they'll offer loss of use coverage. Most HO4 plans also cover your property outside of your place. So if you have a laptop, for example, or other property, you're carrying it in your car and it gets destroyed there, that might kick in. The HO4 might kick in there. Notice the exclusions. HO4 does not cover losses to the dwelling itself. But that makes sense because you don't own the property. You're just renting. The dwelling itself is owned by the owner, and their HO3 policy will cover that. And it won't cover perils from natural disasters, damage caused by pests, and rare items. So if you have collectibles or expensive, valuable things, typical HO4s aren't going to cover it, so you're going to need to get a rider to add on to it. These policies must be a part of your risk management program. They are very inexpensive. They're easy to shop for, easy to compare, easy to buy online. This is really a no-brainer. If you're a renter at whatever life phase you're in, you need this essential insurance. It's inexpensive and you need it. So there you go. Question then is, how much do you need? So we've decided that you need insurance. So now the question is, how much do you need? But it's not a hard question to answer. You just got to go through a systematic process. So to determine your coverage amounts, meaning how much coverage do I need measured in dollars, you're going to answer 3 simple questions. And we're going to assume for the moment that you're an owner, not a renter, to make this easier. Question number 1, what would it cost to rebuild your home if it were leveled? Notice we are not asking what you paid for it. That's irrelevant. What you paid for it years ago when you bought it is irrelevant. You have to ask right here, right now, given current materials and labor costs, what would it cost to rebuild your home? Number 2, what would it cost to replace your possessions? This is where your inventory comes in. And then number 3, again, open-minded, soft eyes, broad thinking, given my property and the way that I live and my lifestyle, what would be my potential liability losses? So that's how much coverage you need. The coverage on your dwelling, so these are the 3. Now let's go into these individually. How much coverage on your dwelling? If you're a renter, it's irrelevant to you. But if you're an owner, we had said you're going to want to base it on what it costs to rebuild your home. See, that's the rule. But it's important that you also understand that if you have a mortgage, we discussed mortgages in a previous video. Remember, when you have a mortgage, you've taken out a loan from a bank, and your home is the collateral for the loan. So if you have a mortgage, your mortgage lender is going to require that you have homeowners coverage. Not only that, they're going to require that you have a sufficient amount of homeowners coverage. And that is typically going to be equal to a minimum percentage of the home's replacement value. So let's say that you happen to live in a home that has a $1 million replacement value. You have a mortgage on this home. Your mortgage lender is going to require you to have coverage on this home. And specifically, they're going to require what's called minimum replacement cost requirement. Like I said up here, minimum percentage, they're going to require that you have a particular percentage of that replacement value as your coverage level. The general default rule is 80%. So the way it works is this. Suppose that you have a home, you have a mortgage, and your lender says we have an 80% minimum replacement cost requirement. Well, this means that you must have coverage sufficient to 80% of that value. In this case, that would be $800,000. So you must have coverage of at least $800,000 on your dwelling. If you don't have that full amount of coverage, and if something bad happens, your insurance company will not cover the full amount. And you might also get in trouble with your mortgage lender. So again, know what the rules are and know how the policies work. By the way, I stated that 80% is kind of what they typically set it at, but increasingly in recent years, we're seeing lenders with a higher requirement. There are now many lenders that have a 90% minimum requirement and even a few that are demanding the full 100%. In other words, they want you to have coverage at the level for full replacement of your home. Okay, so that's the coverage amount. How much coverage on your stuff? That's easy. Do your inventory and then determine if you want your policy to value losses at replacement cost or ACV. That's a fairly simple thing. You look at the ACV replacement, you look at the guaranteed replacement cost, the guaranteed replacement numbers, figure out what the premiums are on those two, make your comparison. But again, to cover your stuff correctly, you have to know how much stuff you have and what method you want to value losses at. And then the third thing is your liabilities. This is a bit harder because it can be tougher to kind of project your liability. Fortunately, today, if you're a homeowner, not a renter, but if you're a homeowner, most newly written homeowners policies, they just build in a set amount of personal liability coverage. If you buy a renter's policy, they'll have suggested amounts that you can play with and kind of get a range. So that's how that works. With that said, I want to introduce you, though, to another important tool, which is related but separate from homeowners policies. And this is what we call an umbrella policy. An umbrella policy is basically supplemental extra insurance. You imagine rain coming down, you put the umbrella up, it gives you a wider coverage. Here's how it would work. Let's say that hypothetically you have on your home $800,000 of home coverage and $500,000 in liability coverage. So that's when I say home loss coverage and $500,000 in liability coverage. If anything happens that exceeds those amounts, so your home burns down and it's going to cost you $1.2 million to repair and replace, or your dog bites somebody and it does $700,000 in damage. In both of those cases, notice that the damage that was done exceeded your insurance coverage. You might be really, really screwed if that were to happen. One way to protect yourself is to buy an umbrella policy. An umbrella policy basically provides coverage above and beyond your existing car or homeowner's policy. It's just one more tool that you have to protect yourself. These are also really good ideas as your wealth level increases. So if you get to the point by, let's say, your mid-40s where you have $1 million of net worth, you should strongly consider buying a $1 million umbrella policy to supplement your existing homeowners and auto policies. These umbrella policies, once again, they cover you if any damage that occurs goes beyond the limits of your traditional plan. And again, remember, what's the goal of insurance? To protect yourself from financial ruin if a bad thing happens. Umbrella policies, they just cost a few $100s per year. They're not expensive. And that's a lot of peace of mind to have for only a few $100s. So that's what you consider. So that, my friends, covers your stuff. Now, so we have our insurance idea, and we talked about covering your stuff. Now we're going to talk about covering you. So now we get into insurance on you as a person. The first type, so this is our third type of insurance that we've covered, but the first type of you insurance is health insurance. Health insurance protects you against any kind of financial loss that would occur if you got suddenly ill, suddenly injured, or had any unforeseen, unplanned, and calamitous, huge medical expense. Now, this is never fun to think about. Nobody wants to think about themselves getting ill, getting injured, being diagnosed with cancer, having to undergo expensive, lengthy, painful treatments. No one wants to think about that. But it does happen. And hopefully it won't happen to you, but you can't base your life on that hope. Health insurance protects you from the financial losses that can occur if you get sick or get injured or have something major hit you. Okay. If you take a look at some basic stats, it's really important to have. Research, when I wrote this up, the most recent research that I looked at suggested that more than half of Americans have unpaid medical bills. Data also suggests that just about half of all credit collection attempts, meaning people can't afford to pay their creditors, so they're getting collection calls, just about half of those are related to healthcare expenses. So getting sick without insurance can rapidly vaporize your assets and put you into poverty. And that's what we're trying to avoid. So you need health insurance. And there's 3 ways to get it. When it comes to insurance, the benefits are very straightforward. The costs that you're going to pay are going to either be your premium, your copay, or your coinsurance. Okay. Again, health insurance policies are contracts. So let's quickly analyze the typical provisions in a policy. And these should not be anything new. Number 1, we have the premium. This is the amount that you pay every month, typically out of your paycheck, for your insurance. That's what you pay for your coverage. Deductible and coinsure, we already covered those. Again, your deductible is the initial portion of any medical expenses that you have to pay first before your insurance company kicks in. Coinsurance is the percentage of any claim that you have to cover with your insurance company, with your plan covering the rest. Excuse me. So again, we have deductibles and coinsurances. A few other small ideas here that come in. Copayment. A copayment in the context of health insurance is a flat fee that you pay whenever you receive a service. Most insurance plans have fixed copayments for certain services. So if you go to the doctor for a routine visit, there's a flat rate payment that you have to make, usually not expensive. That's your copay. You go to get a prescription, there might be a flat rate for prescriptions. That's your copay. Okay. Out-of-pocket maximum. Now you could be thinking, wow, I'm having to pay some deductibles, I'm having to pay some co-insure, I'm having to pay some co-payment. This might get expensive really quick, and it may if bad things happen. An out-of-pocket maximum, this is a provision in any health policy that puts an upper cap on the amount that you would have to pay in a given year for services. So this basically sets an upper limit that protects you from having to be nailed by either excessive deductibles, co-insures, or copays. When you take a look at an insurance plan that you're looking at, when you're shopping around, when you see the out-of-pocket maximum, notice that gives you some mental reassurance. If I buy this insurance, I can predict the upper level of what I'm exposed to. Okay. And then finally, as always, we want to look at exclusions because it's important to know not only what your plan covers, but what it doesn't. So you need health insurance. Where do you get it? You can get it from one of three places. For most Americans, the most common source of health insurance is what we call a group health plan. That's the fancy name that is offered by your employer. So my university has a group health plan that I'm a participant in. Notice that group health plans tend to offer fairly reasonable premiums because by putting lots of people in the plan, all the employees, they benefit from the law of large numbers. The insurance company can spread its risk out, so we typically have lower payments. You can also get health insurance as an individual by just contracting directly with the health insurance company. And for some people, you can get healthcare through the government. So three sources of insurance. Again, the first one is a group healthcare plan offered by your boss. If you have access to this, what it means is, so you get a job, your boss is going to offer you a lot of different benefits. Obviously, benefit number one is your salary. I mean, that's of course why you're working, but there's other benefits to your job as well. So your salary is the cash that you earned, but lots of jobs also provide other benefits. And one of the most common benefits is healthcare coverage. This is often considered part of your total compensation. So when it's not taxable, but when you're shopping around, if you have multiple job offers, don't just look at the salary. Look at the salary plus all the other benefits to get the total compensation. But if you have healthcare plan through your boss, it's kind of a nice thing because typically your boss will cover the bulk of your insurance. So here at the university, for my total monthly premium that the insurance company, for the total monthly premium, yes, that the insurance company charges, my university covers like 85% of it. They pay the big bulk of it. I pay the rest of it. So in other words, you can see that the employer sort of subsidizes you. That's a good benefit. It's especially good if you're married and have family, because oftentimes your employer will not only subsidize you, but also subsidize the insurance cost for your family. Okay, so this is the first source of it. Within this, there's two primary types of health insurance. Years ago, they were far more distinct and the lines were very clear. In more recent times, that's gotten a bit blurry, but it's still worth knowing. You have two potential types, two variations of group health plans. The first, HMOs, health maintenance organizations, and the second, PPOs, preferred provider organizations. Again, The lines between these are getting a lot vaguer. There's a lot more crossover, but it's still worth knowing the difference. Here's what it really comes down to. So let's look at an HMO. An HMO, so it's an insurance plan, no problem. The plan contracts, so the plan itself contracts directly, and here's the key, with a network, that's an ugly line, with a network of doctors and other professionals. And they contract so that these professionals and doctors will provide services in exchange for your monthly premium. Now, one of the things that makes HMOs unique is this. If you're in an HMO, you need to select what's called a PCP, a primary care physician. And this primary care physician is sort of like your main doctor. And what this means is, as your main doctor, you have to go to that doctor first for anything. So let's say that I had some sort of skin flare up. I said, this is really affecting me. I need to go see a dermatologist. I cannot, if I have an HMO, I cannot go to see a dermatologist first. I have to first go to my primary care physician. That primary care physician will look at me, figure out where I need, and then refer me. So that's the key to an HMO. You have to go to your primary care person first, and then that primary care person will refer you to a specialist for whatever you need. So the primary care physician must order and approve all procedures. And then once they refer you, here's the other thing, the specialist. So in my case, let's say I said, my skin's flaring up. I need to go see a dermatologist. I go to my primary care. He says, yes, Eric, I agree. You need to see a dermatologist. He approves the referral, but then I cannot go to just any dermatologist I want. I have to go to a dermatologist who is within the network of providers. By doing this, HMOs attempt to keep the costs of medical care low. Okay. I'll pay a copay to each of those people. I'll pay a copay to my doctor. I'll pay a copay to the dermatologist, but generally outside of the copay, I'm pretty much covered. So these provide some simplicity, but they have the disadvantage of you have to stay in network and you have to go to your primary care doctor first to get a referral. And sometimes they may not refer you, or sometimes your particular plan may not cover certain types of procedures or certain types of referrals. There you go. Second type is a PPO. Now, a PPO, it's also a network, an organization of doctors and hospitals and providers, and they have negotiated with the healthcare firm, with the insurer, to do certain services for participants at rates that are agreed upon. So in that way, it's very similar to HMOs. But here's the thing. These PPOs offer a lot more flexibility. With a PPO, you can see any specialist in the network without a referral. So if I had a PPO, I don't need to go to my primary care doctor first to get the referral to the dermatologist. I just go to the website for my insurance plan, and I can look up my zip code and see all the doctors that are in the network, and I can go directly to any of those without any middleman, without any visit to my primary care, without any referral. Okay. In addition, I have the option with the PPO of going out of network. Now, it's going to cost me a little bit more, but it's an option. You can see that PPOs offer a lot more flexibility. These are especially attractive to, for example, people who have young families. They say, they want to, or let's say that you have a particular doctor that you like. These are attractive to people who want the flexibility to see the doctors that they choose without referrals. So they're good things. Of course, for that extra flexibility, you're going to pay a bit more money. So those are HMOs and PPOs, insurance offered by your employer. There's also individual health insurance. So maybe you're self-employed, or you work for a company that does not offer health insurance, or maybe you work for a company that offers health insurance, but you just think that their offerings suck and you're just not satisfied. Well, in that case, you can bypass the employer and you can basically call an insurance company like Kaiser, Anthem, Blue Cross, Aetna, any of the main insurance companies, and you can contract with them directly. This is really the primary option for self-employed people, because if you're self-employed, you're the boss, so you have to get insurance elsewhere. So that's individual. And then there are, in the forms of Medicare, Medicaid, and workers' compensation, there are healthcare programs issued by the government. So those are your three sources of healthcare, health insurance. Your boss, privately through the company itself, or the government. These plans, let's wrap this up. This is our last slide on health. These plans are essential. You need to have one no matter how you get it, because healthcare, A, is expensive to pay out of pocket, and B, can happen at any time to anybody. And these plans are all pretty comprehensive. I mean, these things cover a lot of stuff. They cover hospital visits, surgeries. Most now cover at least partially prescription drugs, any diagnostic tests and lab work, visits to your doctor's office. They're all included. And increasingly, lots of these plans also add in dental and vision. So they tend to be very good, relatively inexpensive plans that you need to take advantage of. So that's health insurance. Now, in addition to health insurance, there are two unique types of insurance for when you get sick or injured, but your needs are a little bit more ongoing. So health insurance covers you, you get sick, you need a procedure, you need some medication, you need a surgery, boom, 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 it gets done, and then you're back in action. But sometimes it doesn't work out that way. And maybe you get disabled, which means you can't go back to work. Or maybe something happens where you're really banged up and maybe unable to care for yourself, and you need long-term specialized care. In those two contexts, which again are very unpleasant to think about, not fun at all to consider, tragic when you see people enduring these things, but you have to think about things when you're talking about your personal finances. So we have disability insurance and long-term care insurance. Take a look at some of this data I looked up earlier. According to research, a male worker today has a 21% chance of becoming disabled for 3 months or longer at any point in his working career. Now, again, when you're disabled, you're not necessarily going in for regular health care, because it's not like it's not one procedure or one prescription. Like, you just can't work for many reasons, but you're disabled. You cannot go back to work. I mean, 1 in 5 chance of happening. That's major. Another stat said that 1 in 7 workers can expect to be disabled for up to 5 years or more before they retire. Imagine being disabled for 5 years and being unable to work. On top of your medical bills, which would be a lot, but those would be covered by this, you're going to miss out on income from your job. Ultimately, disability and long-term care insurance, they're really insuring your greatest asset of all, you, that beautiful vessel that you are, and all that human capital and earning potential that you have. Social Security Administration, the SSA, has estimated that 3 out of 10 workers entering the labor force today will become disabled. All of this means that there is a decent chance that in your working life, you'll have some period of time where you will be unable to go to work. Maybe an accident, maybe a longer illness, something's going to happen potentially that will impede your ability to work and in turn to earn a paycheck. And of course, without a paycheck, you've got big problems because without an income, you're going to be missing out on cash flow, and that's not good. Disability insurance is what is covering that. And this type of insurance is basically income replacement insurance. When you buy disability insurance, you're paying a firm to take on the risk that you will become disabled. And what these plans do is the insurance pays a portion of your income. You can set the proportion, but it pays a proportion of your income, if you can't work for an extended period of time. Okay. Some basic concepts. First of all, we have a very technical, in this context, definition of disability. Disability refers to self-reported difficulties in one of 5 areas: either vision, cognition, mental processing, mobility, moving around, self-care, taking care of your own needs for preparing food, cleaning yourself, etc., and independent living. Okay. Any of those 5 things, or multiple of those 5 in combination, can lay you out and keep you out of work for either short periods, 2, 3, 4 months, or longer periods spanning into several years. Okay. Disability insurance means that if one of these things happens to you and you can't go to work and you lose your paycheck, you get a part of it, a portion of it paid out to you by your insurance company. Okay. It's optional, but if you have people relying on your income, it's worth considering. There's several ways to get it. The first way, many employers offer a small level of free, it's just included as part of your insurance package, small level of free coverage. So for example, at my university, as a part of my overall insurance benefit package, the university offers me, what's the amount? I think they offer, no, sorry, it's not in dollars. I think they offer, I think it's 67% or something like that. In other words, they take my salary, they take a certain percentage of it, and if I have a qualified disability, I just automatically get a certain percentage of my current salary. So you can get some of that for free in some workplaces, not bad. If you don't get it for free, you can just buy coverage through your workplace. So if your employer does not offer it to you for free, you can inquire about buying it through their broader insurance coverage. Notice also that you can bridge these two. So it's possible to get the free amount from your employer. Let's say that you have a boss, an employer that gives you a 20% portion, a 20% payment of your income for free. Well, you say, wow, that's good, but that's not enough. So then maybe you could on your own buy 55% coverage. So maybe you get 20% free from your boss and you buy 55%. So collectively, for a few bucks a month, you're going to be covered at 75% of your income. Helps you sleep at night, right? And then for some people, depending on where you work and if you're in any professional associations, you might also be able to buy it from a guild or professional group too. And then on top of those ways, it's much rare, but there is one other potential: Social Security. We discussed Social Security a little bit when we talked about FICA, and I had shared with you that Social Security is technically called OASDI, Old Age, Survivors, and Disability Insurance. So for some people, if you're eligible, you can get some disability insurance through Social Security. Okay. Question of how much protection do you need? Well, first things first, how is it offered? Most of these disability policies are written in either dollar terms in increments of $100 per month. So you can buy 100 per month, 2, 3, 4, up to whatever, or as a percentage of your monthly income. So they're going to be offered either in dollar terms or in percentage terms. Whenever I'm thinking about this and lots of other types of insurance, I think one of the easiest things to do is to just consider a strategy. I don't want to say follow. Let me redo this again. We'll call this strategy fill the gap. What does this mean? Well, what you could do is start off by taking your current monthly income after taxes from your job. So you just figure out right now, right here, how much money you're making per month. You would then from there determine what potential disability you'd qualify for based on Social Security, your boss's plans, or other sources. So step one, figure out what you're earning. What would be missing if you got disabled? Step two, figure out the benefits you're already entitled to. And then step three, you basically take number one up here minus number two. You take what you have minus what you get, and the difference becomes the gap. And then you simply buy enough coverage to fill the gap. Okay? So that's disability insurance. Related but slightly different is long-term care insurance. Now, this is really unique and again, very sad to think about, but you can't avoid thinking about it. So far we've talked about an event where you just get sick. Excuse me. You have health insurance, you go to the doctor, you get your prescription or you get your surgery, you're fixed, you go back to work. Boom. We've talked about disability, maybe short-term, maybe long-term, where you're unable to work for a bit and you get bridged, that money is bridged out to you and paid out through your disability plan. But there's something else that might happen. Sometimes, if you think about it, there may be a healthcare event, okay, something bad that happens to you. And this would include a period of time when you no longer need medical care. So you don't need to be in a hospital, for example. The surgery's already done. You don't need to see a doctor every day, but you still need assistance to such a degree that you're confined. So imagine, you have a stroke. Let's say, here's a classic example. You have a stroke. They rush you to a hospital. The doctors do what they can. They save your life. They do their best to patch you together. They've done all they can to fix you. They release you. But if your stroke was really severe, you may need for a period of time until you're really able to function fully, you may need to be confined, maybe to a nursing home, or maybe to your own home, but where you need to receive special care from like a live-in nurse. Whenever you have something that occurs like this, you need to have long-term care insurance. Long-term care insurance, also called LTC, this covers the costs that are associated with providing you extended care when you can't complete basic activities. These are called ADLs, or activities of daily living. If you cannot complete basic ADLs, mobility, feeding yourself, going to the restroom by yourself, bathing yourself, if you can't do those things, or if maybe you had something that gives you severe cognitive impairment, or you have a chronic medical condition that prohibits you from being able to fulfill those ADLs, you might need long-term care insurance. LTC would pay for the specialized care that you need. It would pay for nursing home stays. It would pay potentially to have a specialized care unit brought into your own home, okay? People buy these plans to protect their savings and their wealth because long-term care is very expensive, and they also buy it so that they might have potentially more options. So that's long-term care. The final thing we're going to discuss today is life insurance. So again, we've talked about insurance. We've talked about stuff. We've talked about you. And up to now, the you has been when you're still alive. Health insurance, disability, things of that nature. We now have to get to the one that's really tough one to talk about. A lot of people stick their head in the sand. They don't want to think about it, but we can't avoid reality. We have to talk about insuring yourself, but for when you die. Now, I'm going to start with something it's going to sound silly or insensitive. I don't mean it that way. But let's establish and let's agree that none of us can predict when we're going to die. Well, this inability to know when we're going to die leads to two potential problems. Potential problem number one is that you outlive your savings and your retirement assets. I don't mean to sound insensitive, but this is basically the risk of living too long. And by that, I mean living for a number, basically living too long such that your life goes beyond your assets. In other words, you outlive, you burn through, you exhaust all your nest egg, all your retirement. You've now got nothing in the bank, nothing in the vault, and you're still alive. That's a problem. On the other hand, you might also die too soon. Now, from a human perspective, this is obvious, but from a financial perspective, this implies, what if you have a family, you have a spouse, and you have children? And what if you die young, meaning that you die before you're able to set aside and provide enough to take care of your loved ones after you're gone? Well, to mitigate these two problems, the main tool is life insurance. The way that life insurance works, life insurance pays money out to your beneficiaries, okay, to your survivors. And life insurance simply works by paying out a sum of money to your beneficiaries if you die while you have an active plan. So if you have life insurance and you die while that plan is active, the insurance will pay out a set sum of money to your beneficiaries. Now, whether or not this is important depends on your own needs. I would suggest that if you're single, for example, and you have no children, you don't have a spouse, there's nobody really relying on you, you may not need life insurance. But it does become very important if you have anyone, a partner, children, maybe parents that you're committed to taking care of. If people are dependent on your income, and if your premature death would in turn hurt those people financially, then you want to consider having life insurance. Again, and when you read the data and the research on this, it gets kind of sad. I came across a data point that said that in the last couple of years, they did this research that half of widows and widowers have reported that their spouse who died was inadequately insured, and that these surviving spouses, these widows and widowers, are now facing very, very tight, restrained, and severe financial limits. And this is maybe not a good thing. So there we go. The way to think about life insurance, in my mind, is to ask yourself a very difficult and an unpleasant question, but an honest question. Upon my death, if I were to die tomorrow, what financial needs would have to be met? And I think that you can probably sort these needs into 6 broad categories. Final expense needs, which are basically the cost to get your body, have it transported wherever you want to go, pay for your funeral, pay for your burial, just all those things needed to whether you're religious or not, you're going to do a sacrament or not, just all the expenses to get you from deceased to buried effectively. Income replacement needs. If you, for example, are married and you have children or whatever, and your income contributes to your family, income replacement needs, these are the needs that are related to what your family's losing out on when your income's gone. This is usually the big one for most people. There's also, excuse me, readjustment period needs. So you can imagine, for example, if, here's an example. You work, your spouse stays home to raise family. If you were to die early, if you were to die prematurely, unexpectedly, and if your spouse was going to have to then go back into the workforce, what if your spouse needed some continuing education or some other kinds of training to make their transition in viable? That's a readjustment need. Debt payment needs. If you have outstanding car payments, student loan payments, maybe a mortgage, and you don't want to leave your surviving partner with all that debt, you might want to factor in the amount of debt and have that number built in to the amount of insurance that you carry, so that when you die, your surviving spouse has a chunk of money to pay off the car, pay off the student loans, pay off the mortgage, whatever it is. If you have kids and those kids are going to go to college and your income would have been relied on to pay that tuition in the years ahead, you're going to have college expense needs. And then lastly, but certainly not leastly, are just other special needs that are specific to your situation. Examples might be if you're accountable for elder care, if you send money to your elderly parents to help take care of them and they're counting on that money. Or what if you have a child who might have a learning disability, who might have a physical or a cognitive impairment, who might be basically, sadly, unable due to mental or physical issues to work and earn a salary. And you have said, oh, unfortunately, my child has some issues, and I know that we'll be having to be taking care of this kid forever. Well, if you die early, that special need needs to be taken care of. Once again, when it comes to the financial needs, your best bet is to step back, open your eyes wide, open your mind broadly, and take an honest assessment of all the different financial needs that your income, that your assets are covering. Think critically about it. It's a tough discussion to have. No one wants to think about their death, but you don't want to leave people hanging. And a real sign of adulthood and maturity is to handle difficult topics in a responsible manner to take care of the people that you love when you're gone. Okay, so those are your financial needs. Now, with those needs, there are 3 ways to meet those needs. So once again, we're going to be talking here about filling the gap as a broad way to think of insurance. I call it here closing the gap. You can call it filling the gap. So let's say that you go through all of your financial needs, and from there you get a number. You get a number. Here's what it would cost to cover all these needs. How do you cover those? Well, the first way is with your existing assets. If you already have cash and savings accounts and retirement accounts and things of that nature, your survivors can draw on those assets as one form of help. Now, that's viable, but there's a trade-off. Because if they're doing that, then those assets won't be around for later. There's also government benefits. Remember, Social Security is OASDI. That's old age survivors and disability insurance. Now it's the survivors part. So there's Social Security survivors benefits that the surviving spouse might be entitled to, and sometimes even surviving children might be entitled to. That's a second source. But yet again, another but, number one, those benefits aren't going to be very big. And there is no guarantee that those will be intact decades ahead. We hope they will, but we don't know. So what you can do is think, what's my overall need? You can then look at numbers 1 and 2, your existing assets and potential government benefits. And then by subtracting your needs from these two here, you can figure out what's left over. You can figure out the unfilled amount. You can figure out the gap and use life insurance to fill that gap. And then what you're basically doing is you're setting a life insurance policy amount at a level to where if you died, that payout to your surviving spouse, to your survivors and your children will cover all those unmet needs upon your death. So that's what they are doing there. So that's the question of how you meet the needs. The next obvious question is, how much need do you need to fill? How much life insurance do you need? There's two approaches here. One simple, one a bit more nuanced. They're both fine. The simple approach is called the multiple of earnings approach. Under this approach, you simply take your current salary and you multiply that salary by some random number, just a multiple. So let's say that your salary is $50,000 a year, and you decide that you want to follow a 7x approach. You simply multiply your salary, 50,000, by the multiple 7. That's going to be 350,000, and that's what you set your life insurance plan for. Nice and easy. Very, very simple, very easy, very quick, but it may not always be super accurate. So if you want something a bit more accurate, you go to the needs-based approach. And we already covered that. In the needs-based approach, you categorize all of those, you get the number that you think those would cost, you subtract any other potential benefits, and that's what you do. Notice that the needs-based approach is really much more personal because by definition, you're estimating your life insurance needs by taking account of the unique factors, the unique situations that you live in. You know, this is going to factor in how many kids you have, how old they are, if you're married, if so, does your spouse earn money? Do you have elder care? Do you have kids with special needs? So the needs-based approach is a lot more in depth and takes a bit more time to calculate, but it is much more personal. Okay. So you've decided you need life insurance. You now know how much you need. Now you have to decide, what kind of policy do I get? And this can be hard for beginners because, like many aspects of personal finance, life insurance policies are designed to make you feel dumb and intimidated. They are overly complicated. They have way too much jargon. It's easy to get afraid and just throw up your hands and say, forget about it. But you don't need to. If you strip away all the jargon, ultimately, there are really only two types of life insurance policies. Policies called term life and policies called permanent life. So an insurance policy is either going to be a term policy or it's going to be a whole policy. Whole policies are also called permanent policies. They're sometimes called cash value policies. A lot of jargon, but we'll keep it simple. There's either going to be term life or permanent life. All they mean is this. With a term life policy, You buy insurance for a set period of time. That period of time is the term. So for a term life policy, you buy a insurance policy for a specified time period. That's the term. And if you die within that term, the policy pays out. So here's an example. Let's say that you're married and you and your spouse just had a child, and you figure that you're accountable for this child until they're an adult in college. So about 20 years from now, let's say. You can go and buy a 20-year term policy. With this term policy, you're going to have an annual premium. So you're going to have to pay your insurance costs every year. No problem. And here's the way it works. As long as your payments are caught up and you're making your premiums, if you die within the term, the insurance policy pays out and your surviving spouse and your children get the money. But if you die outside of the term, it doesn't. So let's take a really extreme example. Hopefully it doesn't happen to you. You buy a 20-year term policy. If you die tomorrow or at any other time for up to 19 years and 364 days, in other words, if you die within the term limits, the policy pays out. Now suppose that you buy a 20-year term policy and you live for 20 years and a day, and you die 20 years and 1 day from today. Well, sorry there, Buttercup, because your death occurred outside of your policy's term, no payday. Now you think, well, this is stupid. Can't I just keep on re-upping it? And you can. And that's what you have to do with term. So with term policy, you're going to buy coverage for a set amount of time. Once the term ends, if you want to extend your coverage, you have to renew it. The one good thing about, well, there's many good things. One of the many good things about term policies is they're very flexible because you can buy multiple term policies. So let's say you have a child today. You can buy a 20-year term policy for that kid's needs. And then 3 years from now, if you guys have another child, you can buy a separate 20-year term for that kid's needs. So these can be they're kind of like stackable and customizable, give you a lot of flexibility. On the other hand, you have permanent life, also called whole life. With these policies, there is no term. As long as you pay your premiums, permanent life covers you for as long as you live. There is no term. Okay? So with these policies, they're going to pay benefits at death like term policies. But these policies also have one more provision that makes them unique. I'm not a fan of this provision. I don't really think it has much value, but you may. So be aware of it. And that is this. With a term policy, so again, back up here, pay your premium, pay your premium, pay your premium. If you die, you get the amount stated. That's it. With the whole life policy, same idea, pay your premium, pay your premium, pay your premium. But when you die, regardless of when, you're going to get paid. But there is one other potential source of income from a whole life policy. These policies are also called cash value policies. And the way it works is with every payment that you make, only with permanent life, okay, only with whole life, every payment that you make, you accrue a little bit of cash value. Later on, when you're years in the term, if you need access to quick cash, you can actually tap into your policy and access cash. So again, what this does, it allows you to draw part of the accumulated cash value while you're alive. You can do this by either borrowing against the plan or, excuse me, either borrowing against the plan, or you can surrender the policy by canceling it and then take out any accrued cash value. I'm not a fan of this, but that's the way it works. So just know that those are the differences. Term life and whole life. When you strip away all the jargon and all the fancy things and all the variations, there's really two types of policies. Ones that are valid for a term and ones that are valid for your whole life. That's it. The thing that you need to know is term policies are far less expensive. Permanent life or whole life policies, because of the fact that they cover you when you're much older and it's therefore riskier, as well as the fact that you can draw cash value, they tend to be much, much more expensive. So for many people, they have found that the right tool for the job are multiple term life policies stacked as needed. Okay, there you go. I'll leave you with this thought. Now that we've covered all the life insurance, what are some thoughts on buying it? Well, first of all, you need to think about it. Maybe not right now, but as soon as you have people dependent on your income, you need to consider life insurance, and you want to integrate it with your financial plan and your life cycle. Now, another thought, and again, this is my view, which I share with you. People, insurance brokers who try to sell you permanent life. In other words, the ones who try to sell you whole life insurance, they're going to push you really hard on that. They're going to often sell it to you by saying that with the cash value, it's a better deal. What they don't tell you is, at least right away, it's going to be much more expensive. And what they don't tell you is that in many insurance areas, the brokers get a far higher commission for selling permanent or whole life than they do for term. So if you think about Econ 101 and the power of incentives, insurance agents, insurance brokers have a far stronger incentive to sell you permanent whole life policies. You're going to say, it's a lot more expensive. Why would I do that? And their answer back might be along the lines of, well, you're paying more, but you're building up cash value and you can get that money out. I reject this. I firmly believe you'd be better off by separating your insurance tools from your investing tools. In other words, I'm a fan of keeping the right tool for the job separate. Do not combine insurance products with investment products. Now, again, they're going to say to you, well, yes, this permanent life is more expensive, but that monthly premium, which is a lot more, it builds up cash value. My answer back is, why not just invest on your own? In other words, if you were to take the amount of money that a permanent policy would cost and then take the far lower term policy, I would advise you buy the cheaper term policies, take the difference in monthly premium and invest it on your own. In other words, I would reject, this is just me, I would reject the cash value argument, and I would say simply buy term and invest the rest. Now, with that said, there may be a little bit of room for a whole life policy, and it might be this. This is called the layering theory. And what this would suggest is, you know that you're going to have, whenever you die, your final expense needs, right? Burial, all those final expenses. So some professionals advocate, and I like this idea, they advocate that you buy a very, very small 10, 12, 15,000, a very small base level of whole life Forget about the cash value buildup. You just get the cheapest one possible to cover all your funeral and other final expenses. And then for your actual real obligations to your spouse, to your children, to their education, you use the remainder of your life insurance is composed of multiple term life policies. So you have this really inexpensive whole life, that's the foundational piece. And then as needed, you buy term policies as needed and you stagger them to fulfill your needs. You get the right tool for the job. Obviously, only buy from financially strong, well-known companies. The best policy in the world doesn't mean anything if when you finally die, the company's out of business or going bankrupt and can't pay out the policy. So only buy from financially strong companies and only deal with trustworthy, reputable individuals. If it gets too hard, contact a local agent and get guidance. You can also search online for lots of info to demystify many of these concepts. And then finally, I'll leave it at this. Going back to our discussion on investments, we talked about minimizing your fees. I'll apply the same thing here. Every dollar that goes to somebody else's fee or commission is a dollar that isn't there for you. So part of finding the right tool for the job is also being aware of the sales commissions that these brokers are getting, understanding how different types of policies have different commission structures, understanding the incentives that this leads to, and making the right choice for your needs, not for their needs. And that, my friends, is insurance. Thank you for your time. Have a great day. Talk to you soon.